Dear fellow investors, good day. Greetings from our channel once more. I have a treat in store for all of you today. We'll go into the financial world and examine the top 10 dividend stocks you should think about purchasing right now. So let's get started right away. Let's quickly review the idea of dividend stocks before we begin. Shares of businesses that return a part of their profits to shareholders are known as dividend stocks. It's a great strategy to generate passive income and amass money over the long run. Let's reveal the top 10 dividend stocks at the moment, ladies and gentlemen. We offer our thoroughly researched list in this video. These stocks were chosen after careful consideration of their financial performance, market trends, and growth potential. As usual, before making any investing decisions, it's crucial to do your homework, think about your investment objectives, and assess your risk tolerance. Our goal is to give you useful knowledge and information to support your financial journey. These dividend companies all have yields of over 3% and provide steady income sources during rocky economic times. Given this, it seems sense that many individuals are stashing their money in bonds and high-yield savings accounts. There is reason behind that. But over time, equities have emerged as the most effective vehicle to multiply money, far outperforming bonds and cash. Owning high-quality dividend stocks, therefore, continues to have a lot of appeal despite rising interest rates. Let's now reveal the best 10 dividend stocks of the moment, each with a positive long-term outlook and a beginning dividend yield of at least 4%. Pfizer Incorporated, PFE, is first on the list. The world's largest pharmaceutical company, Pfizer, is in a crisis. The firm had record-breaking growth during the pandemic as sales of their COVID-19 vaccine reached tens of billions of dollars. However, that source of income is essentially ending. Though the PFE stock is currently trading all the way back to pre-pandemic levels, investors may be underestimating how severe the damage is given that the real firm is now considerably larger than it was in 2019. Analysts expect the corporation to produce around $68 billion in sales between 2023 and 2024, compared to only about $40 billion yearly before the epidemic. Investors are currently getting a deal coupled with a strong dividend due to the company's bigger operations and greater profitability. Its 4.5% dividend yield is really impressive. Black Hills Corporation, BKH, comes in second. Black Hills is a South Dakota-based utility business that was established in 1941. It works in both the delivery of natural gas and electricity. While the electricity division has around 220,000 consumers, the gas company serves over 1 million people, mostly in the Great Plains states. Thousands of miles of intrastate gas pipelines, distribution mains, gas storage facilities, and other supporting infrastructure are also owned by the firm. Utility stock ownership is mostly motivated by dividends for investors. Investors have avoided utility shares due to the rise in risk-free interest rates on items like certificates of deposit and treasury bills. In July, Black Hills stock hit new 52-week lows, and over the last 5 and 10 years, it hasn't altered much. That's true even if Black Hills' earnings and dividend have increased throughout that time. In fact, Black Hills is a dividend king, which designates a company that has increased its dividend for at least 50 years running. Wow, the dividend yield is 4.2%. Northwest Natural Holding Company, NWN, is the following. As with Black Hills, the case for Northwest Natural is comparable. Another utility business and fellow dividend king is Northwest Natural. Investors should seize these kinds of chances when these companies sell at multi-year lows, since there aren't many companies with 50 years of uninterrupted dividend growth. Even though Northwest Natural's stock price has been essentially stagnant since the 2008 Great Recession, the company continues to report growing profitability and dividend payments. Given that the company's service area includes Portland, Oregon, where there is occasionally unfavorable regulatory climate, some investors may be concerned about the company's location. Despite this, customers will still need natural gas, and with the most recent decline in the share price, Northwest shares are currently trading for around 16 times forecast profits. 4.5% dividend yield is amazing. Whirlpool Corporation, WHR, is the next company on the list. Leading producer of household appliances such as refrigerators, washing machines, and microwaves is Whirlpool. As individuals hurried to upgrade their household appliances during the epidemic, the firm naturally saw surging product demand in 2020 and 2021. Shares of Whirlpool increased by more than 50% between the start of 2020 and its high in 2021. However, when the sales boom started to slow down, Whirlpool stock lost all of its past gains and is now trading at a significant discount to where it was in the middle of the 2010s. That provides a solid starting point. Even while high borrowing rates are a challenge, the housing market has managed to hold steady because of new house construction, which drives appliance demand. Analysts predict that the business will resume growing its earnings in 2024, and shares now sell for less than 11 times projected earnings. 4.6% dividend yield. Next on the list is PSA, Public Storage. The largest REIT in America with a self-storage focus is Public Storage. Self-storage is a desirable industry. People have a tendency to hoard their possessions, and public storage provides a quick way to make more room. But more than simply the commodity itself is in high demand. Since self-storage is inexpensive to construct, properties can serve as a form of land bank. As an urban area grows, it is simple for a storage corporation to sell property to developers for use as offices, residences, or other higher uses. During recessions, public storage also performs fairly well. That's because major factors for new storage contracts include relocation, downsizing of homes or flats, foreclosure, and other similar situations. Since peaking in 2022, PSA stock has been steadily declining despite the recent rise in interest rates. As a result, Public Storage's yield has increased. Yield on dividends is 4%. The company Verizon Communications Incorporated is next. One of the three major wireless providers in the United States is Verizon. These blue-chip companies have long been relied upon by investors as reliable sources of revenue. Following its disastrous purchase of Time Warner, rival AT&T Incorporated, T. startled investors by reducing its dividend. Even while Verizon is doing better than AT&T, the sector is becoming more competitive. In particular, given that mobile carriers are going through a significant investment cycle connected to the rollout of 5G technology, this has restricted profitability growth and prompted worries. However, given that Verizon stock is trading only slightly over a multi-year low, the anxiety seems overblown. Verizon now trades for less than 7.5 times anticipated profits at this pricing, while providing a dividend yield of 7.7%. Following a Wall Street Journal article in July on the possible significant liability telecom firms may face due to the thousands of lead-encased cables that have not yet been removed and may pose health dangers to the general public, investors have continued to sell off the company. As investors assess VZ's possible responsibility as a result of these disclosures, the stock price can drop even more. 7.7% is their dividend yield. Next is Grupo Aeroportuario del Pacífico S.A.B. de CV, PAC, sometimes known as Pacific Airport Group, is a Mexican airport management company. It manages 2 additional airports in Jamaica and 12 in Mexico. The large metropolis of Guadalajara, the commercial center of Tijuana, and beach resorts like Puerto Vallarta and Los Cabos are prized concessions. Airport concessions in Mexico are valid through 2048 and can be renewed till 2098. Due to the comparatively mild COVID-19 limitations in Mexico, Pacifico saw a quick traffic recovery, which helped the tourism sector. Airport traffic in Pacifico increased 16% in 2022 compared to 2019, comfortably surpassing pre-pandemic levels. The growth is still occurring. Traffic increased by an extra 17.6% in the first half of 2023 compared to the same period in 2022. Although analysts continue to predict a downturn in travel, the numbers have not yet shown it. Although the price of PAC stock has increased over the past year, it is still cheap, less than 17 times anticipated earnings, for a business that is expanding this swiftly. Additionally, the business maintains a variable dividend policy under which it distributes almost all of its free cash flow to shareholders. Its trailing yield, which is calculated by dividing the dividend payments made over the last 12 months by the most current share price, is displayed due to the lumpiness of dividend payments. 4.3% is the dividend yield. Suncor Energy Incorporated, SU, follows. One of the biggest energy firms in Canada is Suncor Energy. It is an integrated oil company that runs a sizable production operation, as well as refineries, energy infrastructure, and a sizable chain of petrol stations. The Alberta oil sands are home to the company's primary producing assets. These desirable productive assets have low decline rates and lengthy reserve lifetimes. This makes fracking look good in comparison, since production rates quickly drop off after a new well is started. Suncor's refining capability is especially advantageous given the lack of pipeline infrastructure in Western Canada, which forces local businesses to accept discounts on their oil sales. By sending oil to its own refineries, Suncor can prevent that. Currently, shares sell for 7 times expected earnings. 5.5% is the dividend yield. One Main Financial is a sizable specialist finance firm, and One Main Holdings Incorporated (OMF) is the parent corporation. It provides consumer credit loans to borrowers with comparatively bad credit. Along with a developing digital lending channel, One Main has more than 1,400 locations in 44 states. Its loan portfolio is currently due for more than $20 billion. Investors' concerns about how a prospective recession may affect the company's credit portfolio have lately caused shares to decline. Consumer balance sheets, however, have stayed better than anticipated, and One Main's financial performance has held up well. Despite the recent rally in the stock price, shares still trade at a favorable price of 7.4 times anticipated earnings. An 8.6% dividend yield. Well, there you have it, folks. Our ranking of the 10 best dividend stocks to purchase at the moment. It's important to conduct your own research before making any financial selections, since stock market trading entails risk. Smiling, host, don't forget to give this video a huge thumbs up, subscribe to our channel, and click the notification bell. As always, I appreciate your time and interest. Happy investing!